Let's model a reverse mortgage for purchase. All right, that is something you can do, and that's something that Right Capital just threw in their various wonderful tools in their software in rightcapital.com. So again, if you want the Right Capital software access, I charge $150 for it. There's no support other than YouTube videos, and I can't guarantee you how long I'll keep it. I freaking love it, man. I love Right Capital. I think it's well worth the money, but be it as it may. All right, so let's dive into this. So remember, we're going to use me for an example. So Charlotte and I, we'll say we had a $400,000 home we just sold. We owe $200,000 on it. So basically, we're walking away with $400,000 in cash. I have $200,000 in cash. Let me draw this out because I'm a visual guy, and I know when I can see it in writing, it helps me remember it. So we owe $400,000. The house is worth $400,000. We owe $200,000. So we're walking away with $200,000 in cash. Now, does that make sense? So with $200,000 is what we're sitting on. So we're going to go into a $200,000 home. We're going to downsize. The question is, should we pay cash money outright for it? So $200,000 of cash to $200,000 home. Was a 5% down payment. VA, I don't know what the VA loans are anymore. So we have $180,000, $190,000 in cash, and in a mortgage. Or should we pay 50% down, $100,000 in a mortgage with $100,000 of equity, or in this case, a reverse mortgage for purchase? So let's go and we're going to model a couple of these things. And Wade Pfau did a good article on reverse mortgages for purchase back in Forbes about a year and a half or so ago, April 2019, which I'll link to the show notes. I initially read this on the video and I said, that's just as Wade, it was boring me. So a lot of good info, but for me to read it, oh man. But I'll put that in the link in the show notes so you can get a gauge how this works. All right. So a couple things you have to assume. You have to assume you're 62. All right. You can't be 60. You have to be 62. For one of the homeowners has to be 62. So keep that in mind. The rules are different based on age as well. So we're for simplicity, we're saying I'm 62. We have 50% is our lending amount that we can borrow. So we can use 50% of the fair market value of the home in which to use for the reverse mortgage. I hope that makes sense. So in that case, we'd say, okay, we're going to take $100,000. Let me just throw this one away. We're going to take $100,000 towards the reverse mortgage, and we'll keep $100,000 in equity. Let me show you what I'm talking about. So here, of the $200,000, we're going to keep $100,000 of cash, which we'll invest, and we're going to $100,000 going to the reverse mortgage. So here we are right now. We walked away from the house. We're sitting on $200,000, excuse me, of something went down the wrong throat. And a taxable investment, because again, we sold the house, so it goes to a taxable investment. What we're going to do is we're going to turn around and buy a house for $200,000. All right, so we're going to buy this house for $200,000. All right, and we're not going to have any property tax or any insurance. We're just going to say the current value of the house is $200,000. Then we're going to go to loans. All right, so we're going to go to loans, and we already got it set up. We're going to have reverse mortgage. We have joint loan. So me and Charlotte, all right, a joint reverse mortgage is a reverse mortgage. So you go to loan type, you see all these different mortgages: adjustable rate mortgage, interest only, home equity loan, reverse mortgage. We're going reverse mortgage. We're saying the interest rate is 5.5%. If we go to Wade's website here, let's open up a window. This is the retirementresearcher.com. So we go here and we got resources, reverse mortgage calculator. Or calculator. We're going to go down here and see what they got. So we got it. I get it. So we are going to say we have a 200,000. What does that need us to do? We're going to say we have $250,000 appraised value. We're going to say the interest rate right there is going to be, what is the rate? 2.73 plus 2.25. 2.73 plus 2.25 plus 0.5, yeah, 5.5%, right on. It's good. 5.5%, we're going to say it is, so 5.5% is the interest rate for the reverse mortgage. All right, we got reverse mortgage, and we're going to take a balance of $100,000. All right, so we're going to use $100,000 on the reverse mortgage, and we're going to link it to that house. All right, so let me set this up again just so you're clear. All right, so what we're doing here is we're taking $100,000 off the table here. All right, so we're going to leave with basically $100,000 of investable assets. All right, so we're going to, let's do this, 100,000 bucks. We got $100,000 of investable assets because we had 200,000 of cash. We took 100,000 invested, and we put 100,000 towards the house. All right, we have a property of $200,000, of which 100,000 is being financed through the reverse mortgage, and 100,000 is being financed through us. All right, and that's what we're doing. But there's no payments on this. Now, again, look, property, I get that. I'm just doing for the straight cut to the chase here. So if $100,000 in investments, I guess not exactly right. Just that's okay. $100,000 loan, but we're gonna have to pay that loan back. The loan is actually costing us 5.5%. But we're not having to pay that, all right? So just going to grow and grow. And we got $200,000 property that we're going to say appreciates at 2%. All right, so in this case, it should be obvious to see what happens here is that we have a $100,000 loan, a $200,000 property. So the property is growing like at 2% a year, but the loan's growing at 5.5% a year. So this should be pretty obvious to see. Let me show you what I'm talking about. Is that we have a loan that's only 100,000 bucks, but because the loan is 5.5%, it's going to be growing significantly more in balance than the property's value is. The property is at $200,000, but it's only growing at 2%. So I don't know what that means in the future. That's what makes this great for the right capital software to be able to model this. All right, so then but we'll keep our investments intact at $100,000, not $200,000, but $100,000. All right, so let's take a look at what we're looking at here, and let's look at retirement. I haven't done this yet, so it'll be interesting. I'm looking forward to it very much. Retirement, we're going to go to cash flow. All right, so I don't care about the proposed plan. We're not dealing with your likelihood of running out of money. I just want to see the nets at the end. So we're going to go to cash flow, and let's see what we're looking at here. So for net worth, we have our home is $200,000. Our mortgage is $106,000. And our qualified assets are 111. Oh yeah, we gotta go. I gotta show you what we did on investment assets, or non-qualified assets. So because we're putting all in equities, we're getting 7.4% rate of return. All right. So basically, we're getting 7.4% on our investments. We're losing 5.5% on our mortgage, on the home reverse mortgage, but we're still getting a 2% appreciation. So let's go back and see what the total net worth looks like when we die. Now, this is just a linear rate of return. I don't know if it'd work very well if we do Monte Carlo. Let's see, because this will just be on the cash, the investable assets. Yeah, I guess that does. So it says your median 539 is your median assets at 7.5% with a 15% standard deviation. Yeah, that works pretty good, I think. But let's take a look at what it looks like from a net worth perspective. I love this stuff, man. I know some people are like, but man, I love it. I can do this all day long. All right, so what do we say? Let's go down. We're gonna go to current plan. Let's go down to the whole thing. All years. All right, so all years we have 712 for a linear rate of return. For the Monte Carlo is significantly lower than that, but it's still over $500,000. So we have 712 non-qualified. All right, so and that's just because this is a linear return, saying you're only getting 7.4% a year. There's no standard deviation. This is just an average annualized return, a linear. So we got 712 investments. We got 334 in home, and our mortgage is and our reverse mortgage is 503. So our total net worth, let's take a look, should be this plus this minus that, which it is. Okay, cool. But it's more than that, because it's a non-recourse loan, which means our net worth is actually, this is wiped out by that. Does that make sense? That is not, let me just double check those numbers. 712 plus 334 minus 503. Yes, 543. But that's not true, because this is not what we owe. We only owe that right there. So those two things are a wash. So we don't get anything from this, but we don't lose anything from here. So our total net worth is actually 712, because these two things wash. the mortgage amount can never be higher than the fair market value ever, because it's a non-recourse loan. So we actually walk away with 712 for the estate. Now they don't get a house; the bank is the house, but our estate walks away with 712. Isn't that interesting? In fact, you can see it right here. This is when it turns, the difference between the value of the home at 269 and the reverse mortgage at 260. All right, so now oh boy, that's freaking awesome. All right, let's try something else. Let's try something else. Go to profile. Instead of doing S&P 500, let's put it in, I don't know, let's zero this out. Oops, I don't want to do that. We'll just zero this out, and we'll add, instead of doing that, let us save that there. Okay, cool. Oh, I guess it took it away. Let's do the Ginnie Mae, and we're gonna do $100,000 of Ginnie Mae divided by 1057. It's 9,400 shares. Okay. I'm going to show you the difference in what it looks like if you go to bonds. Kind of going back to my whole thing, if you have a mortgage, you don't want any bonds. All right, so it's starting off 5,000 less. I guess it's a non-issue. Cash flows. So in here, if we go to net worth, and let me just show you for bonds. I think we only got a 3% rate of return here. Yeah, 3.1. So we're going to go to retirement, cash flows. We're going to go to net worth. And we're going to go all the way down. So in here, we got 228 is net worth. So that's S&P 500, that's Ginnie Mae. All right, so we got 228. So if you're going to do a reverse mortgage, I'm telling you, if you're doing any mortgage, you do not want bonds. All right. Again, these two things will offset. The value of the home will be offset by the debt in the home, or vice versa, because it's a non-recourse loan. You can't owe more than what the value is, because you're paying a fee for that. It's 0.5%. I mean, as you can see right here, this fee right here is the monthly insurance premium. What's that? Well, it's used to support the government's insurance fund that will provide a guarantee to both the borrower and the lender. For all loans issued at the present, it remains permanently fixed at 0.5%. Principal limiting factor, that's what it is. And then on top of that, you got the initial mortgage insurance. So it's the amount. So in this case, it'd be insurance premium charged by the government when the loan is made is based on the HECM eligible amount. So basically what you're doing, if you have a $200,000 home, was it 3% of it, I think, 250, what do they got here? 2%, it's 2% of the value of the home. So it's that costs $4,000. That goes to make it non-recourse. All right, so let's go back, and let's say we don't do any investment. We're gonna have no investment at all. All right, so let's get rid of this, and we're gonna say we just do 100%, we're gonna put 100% down on the home. All right, so let's go here. We're not going to have any loan. We're just going to have a property of 100% down. So we literally, all we're doing here is we're saying we own the house outright. That's it. So let's take a look at net worth here. Make sure we save that. We're going to go to retirement. We're going to go to cash flows. We're going to go to net worth. And here's just the value of the home growing at that 2% rate, 334. All right, no debt, 334 is your net worth. Isn't that interesting? All right, so let's do another thing. Let's say we do a profile. We're going to put 5% down. Property, $200,000. We're going to take a loan. It won't be a reverse mortgage. It'll be a first mortgage. And we're going to say we've got a 5% down on $200,000. Yeah, it's $190,000. We're going to borrow $190,000. All right. We're going to have it. Oops. 2019. We're going to do it for 30 years. Primary home, we're going to say interest rate's 3.5. All right. We're going to have balance right now of 190. Does it calculate the payment first? I think it does, doesn't it? Let's see. Yeah, 853. All right, cool. Do I got to put the 853 in there? Let's see. Hold on a sec. Let's go to retirement. I can't remember if I have to put that in there or not. Ooh, I got to do something else. Hold on a sec. Hold on a sec. So we got to put 190. Okay. So we got to put 190,000 in investments. 100. So we're gonna do VOO 190,000 bucks divided by 2297.23. That's 600. We'll just do 640 shares. 640. We'll have a cost basis of 190,000 bucks. Okay, cool. All right, so what we're doing here is we're putting 5% down. All right, so we got 190,000 to grow, invest, but of that money, we got to take it out to pay for the mortgage payment. That makes sense? Let's see if this modeled correctly. Hold on a sec. Let's see what we got. Let's do cash flows. I want to see if it's actually taking the mortgage payment out. Expenses. That should be the mortgage payment. Yeah, sweet. Okay, cool. Look, and they even have amortization. I freaking right, Capital. Will you marry me? I love you. All right, so they're amortizing. That's fantastic. All right, so now we go to net worth. Ooh, it gets crazy. It's gonna be exciting. So we have a $200,000 home, of which we have only $10,000 of equity, but we have $190,000 that's growing in the S&P 500. Let's take a gander, shall we? Let's gander. All right. So now we got a mortgage. When we die, we got 260 in the market. 260 in stocks, 248. Oh wait, 491 in stocks. Excuse me, 491 in stocks. There we go. So we got 491 stocks. We got 334 minus 229. We got 305 in the house. Plus 491 equals 796. All right, so that does pay. In this case, you get a difference of 796 minus 712 of $84,000 when you're 90 years old. So in that case, it works to leverage because literally you're leveraging it. So you take the mortgage debt. Let's just see here. We're gonna have accounts. It should. I hope it's coming from accounts. Withdrawals from accounts. It should be. Yes, it's taken from the accounts. So it's taking that mortgage payment from your taxable account and is using to pay the mortgage. In that the case, you're gonna have $84,000 more. That's interesting to me. Just because of the home equity, the reverse mortgage is actually paying 5.5%, and your debt is only 3.5%, and your debt's fixed, and your markets are going 5. All right, so okay. Well, I wonder if we do one other thing here. Let's go back to profile. All right, that's good. If we hit loan, can we have a reverse mortgage? Annual income where we pay it. I don't see it there. So annual fee, annual income, is that how much you're, all right. Yeah, that's how much you're, It doesn't let you pay it looks like. That's weird. I would like to if it let you pay. I don't see a way it gives you a payment option here. So, but that defeats the purpose, by my opinion. Okay, cool. All right, so at the end of the day, the reverse mortgage, you shouldn't pay cash for the house. What if we did 100,000? Wait, what did I do before? I did 190,000. So you have the cash, but oh, let's go back. I want to show you something. We did what 200, 100. What did we do? 190,000 here? Yeah, 190,000. There we go. 2019. Term 300 years. We're in default there. All right, cool. what I wanted to do is go to retirement, and let's do the Monte Carlo over confidence. Yeah, see, there is still a probability that you're gonna not have any money. Only 79%. So that's this doesn't include your home. This just includes your cash. But the facts are here with that monthly payment. If the market turns against you, there's a chance you could run out of money. And that I still think the reverse mortgage is the way to go. Go back to profile. Go back to loan. We're gonna make this a reverse mortgage again for $100,000. We're gonna make it 5.5%. And here, though, we're gonna go back to $100,000. So 320. So 320 there. Yeah, okay. Let's go to retirement. Not run out of money. So here, you're not running out of money, you're just running out of house. The other one, you're not likely to run out of money, but it's not as definitive. And a significant, wait, did I get 190 on that? Yeah, 490, yeah, right, it started 190. Yeah, that makes sense. So we're doing $100,000 invest. Oh wait, am I right? Is that right? Hold on, did I change that investment to 100? Yeah, I did. So here, oh wait, I gotta get it off the. Yeah, that's right, because you're not paying in cash. Okay, that's right. So go to retirement again. We go to cash flows, net worth. Yeah, okay. That's a tough one. I like the idea of having the cash. I don't like the idea of paying off the house. So let's put it that way. I like the idea of having the cash. You got $100,000 of cash, $100,000 towards the property. The other one you had with no payment. The other one you had $190,000 towards of cash. I'm saying cash investment with a monthly payment of $850 with only $10,000 equity. But you have the mortgage. Man, that's a tough one. Anyway, that's how you model right capital, reverse mortgages and right capital. I'll put the links in the show notes. Love to hear your thoughts on this. That's a tough one. I mean, so basically you're saying I got $100,000 of equity in the home. I know I'm going to lose my home when I die. And I hate to say lose. It doesn't mean like you're going to be put out. But I know I'll have hopefully more assets, liquid assets to leave to my kids. They don't have to worry about the probate and all that in the house. The other one, though, I have a monthly payment and a little bit more risk. That's a challenge. That's a challenge. It's something to think about. Love to hear your comments. All right, let's see.